Welcome to The Explainer, where we break down big topics. Okay, let's dive right in. Today, we're going to demystify a really powerful financial tool that's all about choice and flexibility, the option.
Let's forget about finance for a second and just start with a situation you can probably relate to. This simple question, believe it or not, gets right to the very heart of what an option is all about. You absolutely love it, it's everything you've been looking for, but maybe the timing just isn't right. So you have this dilemma, right? How do you make sure nobody else snags it without having to commit to buying the whole thing, right here, right now? Now, let's be clear. This $5,000 isn't a down payment. Think of it more like a reservation fee. It's the price you pay to lock in that price just for you. It basically buys you time to decide without worrying about the price shooting up. And this simple idea, well, that's the key to understanding options.
So here it is. The crucial point is this. An option is really just a contract for flexibility. In the stock market, one of these contracts typically gives you control over a block of 100 shares, all without the immediate and expensive commitment of actually owning them. It's all about having a choice.
What's really cool is how our simple little house story translates perfectly to the official language of the stock market. So let's go ahead and decode that contract. Remember that $5,000 reservation fee you paid? Well, in the world of options, that's called the premium. That locked-in $300,000 price, that's the strike price. And that one-year deadline you both agreed on, we call that the expiration date. See, you already get the key terms. It's that simple.
So at its core, every option contract is basically a bet on where you think a stock is headed in the future. And that bet can go one of two ways, up or down. This brings us to the two main types of options you're going to hear about.
Our house deal? That was what we call a call option. It gave you the right to buy the house. You would use a call when you're bullish, meaning you expect that stock price to go up. The exact opposite is a put option. That gives you the right to sell, and you'd use it when you're feeling bearish and think the price is going to go down.
If you remember just one thing from all of this, please make it this right here. You paid for the choice. And here's the brilliant part. If you decide not to buy that house, you can just walk away. The absolute most you can possibly lose is the premium you already paid. That's it. This isn't just power, it's a built-in safety net.
Okay, so we've covered the what and the how. But why does any of this actually matter to you as an investor or a trader? What's the big deal?
Well, unlike buying stock where you've got to pony up the full price right away, buying an option lets you control the same number of shares for a much smaller initial cost, that premium we talked about. It's a way to get in on a stock's potential movement with a lot less of your capital at risk.
And that's really the fundamental shift in thinking here. Stock is about ownership. Options are about control and flexibility. And that opens up an entire world of new possibilities, from protecting your portfolio to generating income. So the real question isn't just what an option is, it's this. What could you achieve if you focus less on ownership and more on the power of flexibility?